All right. Well, hello, everyone. I want to welcome you all to this evening's event. Tonight, we're going to be exploring 1031 exchanges and how to sell property without paying any taxes. This is a topic I am very passionate about. I actually just finalized my first 1031 exchange a few weeks ago using tonight's preferred vendor, Dino Champagne, and it was an absolutely incredible experience. I'm very excited about what the exchange that I went through did for me and my family and what they can do for you as well. A quick housekeeping item before we kick off though, just to be cognizant of time, we're actually not going to be answering questions live tonight on the webinar, but please feel free to go ahead and type your questions into the chat box and Dino and I will get back to them later this week to get you answers this week. So with that said, let's kick it off. Alrighty. So with that said, I know a lot of you guys in attendance tonight, but for those of you that I haven't had the opportunity to connect with, my name is Rachel. I'm a realtor and advisor here on the team at Marshall Reddick. I grew up in Seattle and then moved down to sunny Southern California for college. I have my bachelor's degree from Vanguard University. I'm also a licensed realtor in both California and Texas. My journey with Marshall Reddick actually started 10 years ago when my husband and I bought our first investment property as clients. Fast forward to a decade, 8 doors later, and here I am tonight. I've seen firsthand what this company's done for me personally and my family legacy, and so I'm really passionate about what we can do for investors as well. I knew I had to make the jump from investor to partner, team partner a couple of years ago, so that's exactly what I did. And I'm definitely a true believer in what Marshall Reddick can do for our clients. I've seen it firsthand. So a little bit about our services. Marshall Reddick really is a one-stop shop for all real estate needs beginning to end. We were founded as a brokerage, so we definitely still help our clients buy and sell residential real estate. Some of those clients are shopping for a primary residence in any of our markets or a vacation home. And a lot of other clients come to us for one-stop shop investment property services. So that's, like I was saying, that's how I began my journey with Marshall Reddick, was purchasing an investment property. We're also a private money lender. So we help clients by providing private money loans to fund a variety of programs. And on the flip side of that coin, we also have individual investors that fund each of those loans. And we also have the Marshall Reddick Fund, which is available to accredited investors. And it's just a really incredible passive income option for clients who are able to qualify for it as well. And we offer incredible in-house property management services in our primary markets as well. So if you are investing in real estate long distance, which the majority of our investors are, your property manager is definitely going to make or break your success. And I can absolutely speak to the incredible services of our PM team because I'm also a client of property management. So as you can see here, our team at Marshall Reddick really believes and embraces in the services we offer. I'm a client in almost all of these individual facets myself and can speak from experience how much it's done for me. So our markets, we offer brokerage services in 16 major metropolitan markets. Of those markets, our primary Marshall Reddick markets are California, Central Texas, Southwest Florida, Tennessee, and Kentucky. So almost daily, I have clients reach out and want to know why we choose the markets that we're in. That's an excellent question and extremely important to the health and stability of any thriving market in real estate. So these are the 7 different facets we look at. So job market, we want to know that there's a variety of jobs in different industries in that it's not dependent on one particular company or facet. We want to see a thriving job market that spans multiple industries. Vacancy rates, we want to look at the rental market and make sure that they have low vacancies, that the amount of properties hitting the market versus what's available is at a healthy rate. We want to make sure that number is low. Economic diversity, we want housing affordability. You can see this in all of these facets in all of our primary markets. Our houses still, even with the prices going up, are they still affordable as investments? Number 5, I would say this is arguably in the top 2 most important. Is it landlord friendly? You want to invest in states that have laws written in the favor of the landlords especially with what we've seen over the last couple of years. We've seen our investors really protected in these landlord-friendly states, which has been very much in their favor. We want to see a strong education system, a lot of good options, good universities. That's important to our markets, and reliable property management. That is very much an important thing. Your property management, like I was saying, that can make or break your investment. You need to be able to trust these companies, because in reality, you're probably not going to have your eyes on the property in person if it's a long distance investment. So you need to know you have a partner and an advocate who's honest and has your best interest in mind. So real quick before we dive in, like I was saying earlier, I actually just went through my first 1031 exchange with Dino myself this spring. So I wanted to walk you through the real life example of what these figures look like. So we purchased, this is our second investment property we purchased with Marshall Reddick, single family property in Cordova, Tennessee in March 2017. We paid $129,900. As you can see, the compound appreciation average for the greater Memphis market sits at 2.87%, which is a reasonably strong market. It's performed well historically. But my husband and I really just wanted to take advantage of the equity we had sitting in the property and redeploy it in a stronger market. So partnering up with Dino, she walked us through. It was wonderful and seamless. We sold that property in March of 2022, this past March, for $300,700. So then we purchased a single family property in May of 2022 for $505,000. So we purchased that in the Woodlands, Texas. As you can see, we were able to move our capital into a market that has greatly increased historical appreciation and made our money work almost twice as hard for us. This is the same graph, which by the way is pulled from the National Association of Realtors. They're considered the utmost authority on the historical trends of these housing markets. So, as you can see here, for that market, we're sitting at a 4.49% historical compound appreciation, and just really able to utilize the 1031 and take advantage of an asset, utilizing an asset that had a lot of equity, and then redeploying those funds into an even stronger market. So real quick breakdown on what this actually looks like. We took our initial down payment for the house when we first purchased that Cordova property. We paid $25,980 for our initial down payment. That was 20% down. Then when we decided to sell the property, we rolled all of that over, that equity rolled over into our upleg property, which we put at $189,710 down payment. So we're able to actually come to the table with a 37% down payment on our upleg property. And it's an amazing home in arguably the top area within the Woodlands, but it was a little bit dated. So we were able to deploy, we took $45,000 out of our rental reserves that was passive income we had made on that Cordova property, and update that property. That cost us nothing out of pocket that the property hadn't paid for itself. So we brought the property value up to $550,000. Now, if you take that figure where it's at today and apply the historical market appreciation trend, which given recent years is a very humble estimation. If you take the date we originally purchased into when it should hypothetically cross the $1 million threshold, we would have turned under $26,000 into over $1 million asset in just 20 years, which is amazing. I'm a huge believer in this process. So just thought you guys could benefit from seeing firsthand what I just did using Dino. So with that said, it's my pleasure to introduce you to the woman of the hour, Dino Champagne. She's a top-ranked exchange accommodator. She's helped countless Marshall Reddick clients hold onto their assets in generational wealth through the years as our preferred vendor. At any given time, Dino and her amazing team are helping dozens of our clients with exchanges. Usually she's helping at least one of my clients, usually multiple at a time. Like I was saying, she just helped me go through my first exchange with her myself, which was awesome. And I always love hearing what she has to say. So with that, I'll turn it over to Dino.
Thank you, Rachel. No pressure there. Anyway, all right. So let me just give you a little bit of background as to my experience with asset preservation and who we are as a company facilitating 1031s. Asset Preservation is a national 1031 qualified intermediary. As a company, we have facilitated over 200,000 exchanges nationwide. We've been in business since 1990. We're owned by a large title company. Stewart Title happens to be our parent company. So you've got the experience of us handling over, like I said, over 200,000 exchanges, along with the financial backing of $1 billion title company. My experience, I've been with asset preservation for 20 years now, and prior to joining asset preservation, I was a commercial broker, and prior to that, I was a banker. I like to say I started when I was 2, but fortunately, we're not live on the cameras, so I don't have to lie about my age. Anyhow, so that's who I am. That's who our company is. And then when Rachel said she wanted to share her experience, I went, did we do okay for you, right? She said, yes, you did. I said, good, okay. All right, so what I'm going to do, the presentation I have for you this evening is I'm going to go over the basics of a 1031. This presentation by no means covers every aspect of the 1031. And then as Rachel mentioned, there's not going to be any live Q&A. So any questions you have, please feel free to type it in the chat. And as she said, we'll get back to you later with the response. All right, so let's get started. So when you're doing a 1031, let's see hang on. There we go. Okay, there's certain things we're going to cover. So what I want to cover is, capital gain, why we do a 1031s. I'm going to take you through this IRC section itself because this is a part of a tax code. We're going to go through what's like-kind property. I'm going to take you through what we call the exchange equation. I'm going to bring you through the exchange process, the identification rules, and then at the end, I want to go over some tips that I think help complete successful exchanges. All right, so let's just start about why people do 1031s. A 1031, as I mentioned, is a part of the tax code. It's been a part of the tax code now for over 100 years. Fortunately, we're still here. Congress every now and then likes to, think about removing or eliminating 1031s. We do have a lobby, so we make sure that people understand and Congress understands the values of a 1031. So what happens is, as an investor, you're operating a property. When you go to sell that property, you're potentially subject to 4 different taxes. When you're operating investment property, you're doing something that's called depreciation. For those seasoned investors that are on the webinar, you know what that is. You've been depreciating the property, which has been lowering your real estate taxable income while you've been operating the property. For new investors, this would be something that you would see as you're operating the property. So if, for example, if you're making, $30,000 in rent, your depreciation will lower that. When you go to sell the property, there's a tax rate that's associated with that. And that tax rate is at 25%. It's called recapture. Then there's the capital gain rate. The capital gain rates right now range anywhere from 15% to 20%. You're going to get into the 20% capital gain rate if your income, if you're a single taxpayer, is more than $459,750. If you're a married couple, $517,200. If your income and the gain on the sale of a property could throw you into this, your capital gain rate would be at 20%. Anything below that figure is going to be at 15%. And then there's the net investment income tax. Most of us know this as the Obamacare tax. That's an additional tax at the federal level that if your income, if you're a single taxpayer, is more than $200,000 or a married couple more than $250,000, you're going to be subject to an additional 3.8%. So as you can see at the federal level, you've got 25% for recapture, either 15 or 20% for capital gain rates, and potentially another 3.8% at for the net investment income tax. Now you have the state income tax. If you live in the state of Texas or Florida or somewhere like that where there's no state income tax, then you don't have to worry about any tax for the state. If you're living in a state like California, our tax ranges anywhere from 9.3% to as high as 13.3%. So as you can see, when you're doing this, when you're selling an investment property, you're going to be subject to these taxes. The beauty of the 1031 is it gives you an opportunity to defer those tax. So just think of it, if you had a tax liability of $100,000 and you wanted to stay invested in real estate, if you have to pay the taxes, that's $100,000 less that you have to spend. So this is why we call it the power of an exchange, because an investor gets to keep that $100,000 and redeploy it into an asset or assets in real property for investment. All right, so that's the beauty of the 1031. Now let's talk about the transaction, because in any transaction, there's always going to be pros and cons. So let's talk about the positives. Well, what does the 1031 do? Well, as I just said, it helps you, you defer the tax at the federal level, and California does comply with the 1031, so at the state level as well. There are some states that have some nuances when it comes to 1031s. For example, Georgia, if you're selling out of Georgia, unless you're buying in Georgia, you're still going to be subject to Georgia's income tax. If you're in Pennsylvania, you're going to be subject to Pennsylvania's tax. Pennsylvania does not recognize 1031. While you're still deferring federal, you're not going to be deferring their state income tax. Majority of the states comply with the 1031. So I'm deferring the depreciation recapture tax, the capital gain rates, net investment income tax, and for the states that apply the state income tax. Another advantage is the accumulation of wealth, because you're preserving equity. And what do I mean by that? Instead of, as I just mentioned, instead of giving the funds to the IRS or to whoever state taxing authority, I'm using that money to go off and buy more property. And I can build my wealth by leverage. And that's a big key advantage to doing 1031s. If I have low loans on my property that I'm selling, I can get more leverage to buy more property. I can diversify not only geographically but also by asset class. Again, an advantage to a 1031. And then right now, it's still a good advantage for estate planning. Sometimes people will exchange. When they pass away, their heirs will inherit the property. Under current tax law, there's a step up in basis, and therefore there's no tax that's going to be associated passed to the heirs for the capital gain tax that have been deferred. So again, one of the advantages, for doing a 1031. Well, with every pro, there's going to be a con, right? So let's talk about the downsides to 1031. Well, there's going to be these pesky rules and timelines that you have to deal with, and we're going to go through all of that. The replacement property does not get a brand new basis. So in other words, your old basis moves with you to the new basis. Lack of liquidity. What do I mean by that? I mean that all the money that you're spending, if you're not going to pay taxes, has to be redeployed in real property that you're going to hold for investment. If there's losses, and you do the exchange, you're not going to be recognizing those losses on that transaction. Also, there's a possibility of higher taxes in the future. And again, it's only tax deferred, it's not tax free. So those are the pros and cons of doing an exchange. Now, what I want to take you through is the guidelines right now as to what the IRS requires in order for you to defer the tax. So there's 4 basic guidelines that an investor, when they're embarking on this type of transaction, has to be aware of. First is going to be the property qualifications. The property that you're exchanging must be real property, so it has to be real estate that has been held for trade or business or for investment. The next guideline is going to be, how much do you have to spend? So we call that the exchange equation. So when you're doing an exchange, you have to buy property or properties equal to or greater than your sale price. You have to spend all of the cash, and you have to replace any existing debt. Now, when I say sale price, I mean net the closing cost. And we're going to fine tune this as we go along. The third requirement is going to be the timeline. Regrettably, the government gives us only a certain amount of time to do this. So at the close of escrow, you have 45 calendar days to identify, and then 180 calendar days to finish the exchange. Both 45 and 180 start at the closing of the sale. And then the fourth guideline is you have to identify the properties properly in order to comply with the exchange. So let's go through each one of these guidelines. Okay, so the first guideline is property that has been held for trade or business or for investment. A lot of you have probably heard the term like-kind property. So when it comes to like-kind property in a 1031, sometimes people get caught up in going, well, if I sold a single-family rental, I must buy a single-family rental. Or if I sold a duplex, I have to buy a duplex. That's not the case. In a 1031, think of it this way: investment real property for investment real property. So you can go from a single tenant triple net and maybe buy a bunch of single family homes, or you can go from an apartment building to an industrial building. So like kind means real property for real property that I intend to hold for investment purposes. Now let's talk about what is excluded from like kind property. Sometimes people would like to do an exchange and they go, well, I want to buy a property that I can live in. You cannot buy a primary residence in a 1031, nor can you sell your primary residence and do a 1031. So it does come up where people have a lot of appreciation on the sale of their primary residence, and the last use of the property is a primary. They go, well, I want to do an exchange with the difference after my exclusion. You cannot. That's a completely different tax code. So primary residences are excluded from 1031. There are instances where these two tax codes go hand in hand. Don't have enough time to go through that for this presentation, but there are options out there. Also, what's excluded is property that has been held as what we call dealer property. So people that like to fix and flip or build and sell. That's considered dealer property and therefore would not qualify for a 1031. All right, so those specific types of property are not part of a 1031. So again, just to reiterate, 1031s, real property that's been held for trade or business or for investment. Now, we do get the question often, well, how long do I have to hold the property for it to have been declared held for investment? Well, here's the good news and the bad news. The good news is there's no mandatory holding period. The bad news is you have to be able to substantiate that you held the property for investment purposes. So people say, well, you know, I've heard it has to be 2 years, or I've heard it had to be at least a year. Well, those are just merely guidelines, if you will. The key that the person that's going to be able to help you determine, did you hold that property for investment purposes, is going to be your tax advisor. So when you acquired the property, was that your intent to hold it for investment purposes? So some might look at it and say, well, I feel comfortable that if you've held the property for at least 24 months, that would qualify as substantiating that held for investment intent. All right, again, a guideline, not set in stone. So that may be a good indicator that 24 months would be a sufficient time. There was a revenue procedure that came out in 2008 that addressed vacation homes. And in there, it clearly stated that if you hold the vacation home that you want to convert to an investment property in order to do an exchange, you have to have it for at least 2 years prior to the sale. So that's why some people look at the 2-year period. Again, discussion between you and your tax advisor. Some tax advisors may think, well, 12 months is sufficient because it covers 2 tax returns. If I hold an asset more than 12 months, then I'm under long-term capital gains. So that may be also an indicator that maybe 12 months is sufficient. Again, this is a decision that's going to be made between you and whoever does your tax returns. You have to substantiate your initial intent. The time was to hold that property for investment purposes. All right, so as we like to say, there's no safe holding period. Just make sure that you're talking with your tax advisor, especially if you have short-term holds. All right, so let's go now to the next guideline, the exchange equation. So when you're doing an exchange, sometimes people get confused about what they have to reinvest. So here's an example of what's required in order to try to achieve full tax deferral. You have to buy property equal to or greater than your sale price minus the closing cost, spend all of the cash, and replace any existing loan. So here in my example of the exchange equation, the investor sold a property for $900,000. The loan at the time the sale closed was $300,000. There was closing costs such as the commission, the escrow fee, the transfer fees and such, say of $60,000. So the cash that came into the exchange was $540,000. Bought a replacement property for $1.2 million, put down the full $540,000, acquired a loan of $660,000. So in this example here, the taxpayer would have achieved full tax deferral because they spent all of the cash and they replaced the loan. This is also an example of utilizing leverage to buy higher valued property. Okay, so that's what we call the exchange equation. Now, there are instances where people might want to purchase lower than what they sold for. The good news in a 1031 is to understand it's not an all or nothing system. All right, so you can do what's known as a partial exchange. So here's an example of that. I sold for $900,000. As an investor, I'm choosing to only buy one property for $700,000. The loan was $300,000. I'm only acquiring a loan of $260,000. Now, I know this looks strange, but I'm doing this for a reason because I want to show you that there's two types of boot. So when you hear the term boot, all that means is that is taxable. That's the exchange terminology for taxable. So there's mortgage boot and cash boot. That's why we have an example here of mortgage boot. So in this example here, I acquired a loan, say if I'm the investor, for $260,000. I put down $440,000 to meet my purchase price. So now I am going to be subject to tax on $140,000 because what did I not do? I did not spend all of my cash, nor did I replace all of my debt. Now, sometimes people get confused and go, well, wait a second. When I paid off that loan, I didn't receive any money. So why am I having to pay tax on that $40,000? When you think about debt, remember, debt is money. It's just money that belonged to somebody else. That's why you have to replace it. Okay? So if you do a partial exchange, that's totally acceptable. You will pay tax to the amount of gain on that portion. All right? It's not an all or nothing system. What's important to understand when you're thinking about doing a partial exchange is, are you still going to benefit from the exchange? What do I mean by that? The government is going to go after, so the taxing authorities, they're going to go after the gain portion first. So if the boot, the money not reinvested, is either equal to or higher than the actual gain amount. Now, to calculate gain, that's your sale price minus closing cost minus adjusted basis. If your gain is less than the boot, then you're not benefiting from the exchange. You're going to pay tax on the gain. So for example, if my gain on the sale of this property was only $100,000 and the boot, the portion I did not reinvest, is $140,000, I'm going to pay tax on the $100,000, not the $140,000, but the $100,000. So at that point, doing an exchange did not benefit me. If my gain is $300,000 and my boot is $140,000, I'm still protecting tax on the $160,000. So if you're considering a partial exchange, you want to make sure that you're running the numbers to see that you're still going to benefit from doing the exchange. Now, here's another example where people can be very, if they're not careful, they can step into something that's going to be taxable. People sometimes focus solely on what I have to buy property higher than what I sold for. So in my example here, got you selling for $900,000, buying for $1.1 million. So if you stop at and only look at, I'm buying more than what I sold for, thinking you're safe as an investor, here's my example to show you that you're not. So in this case here, the investor, say for example, went out and got a loan for $700,000 when they had a loan of $300,000, okay? They only put down $400,000, which makes your 1.1. So because they did not spend all of the cash, that $140,000 is going to be taxable, even though they bought property higher than what was sold. So as we talk about the second guideline, you must spend all of the cash and replace the debt. To the extent you do not do either, then that portion is going to be taxable to the amount of gain recognized. So be careful about not getting too much of a loan, by getting too much of a loan, I should say, and not spending all the cash. All right, so watch these numbers. All right, so now let's talk about what costs are considered acceptable expenses and what are not in an exchange. Now, this is not an extensive list, it's just a guideline. So real estate commissions, title insurance premiums, closing costs, attorney fees, any legal fees associated with the transaction, transfer tax, recording fees, the qualified intermediaries fees. Those are considered acceptable exchange expenses. Then there are expenses that may be a part of the transaction, which are not considered acceptable exchange expenses because it's not a cost of transferring the property. So let's go through some examples here. If, for example, you're selling an apartment building or duplex or fourplex or something like that, where you're going to have prorated rents and security deposits, it's very common to see on a closing statement where the parties have negotiated that the seller will credit the buyer with the prorated rents and security deposits. What that means is that the buyer is not bringing in that money. So, for example, if the prorated rents were, say, $20,000 and the buyer is buying the property for $1 million, they're only bringing in $980,000 because they're being credited for the other $20,000. For the party doing the exchange, selling the property, that's $20,000 less coming into the exchange. So that $20,000 would be taxable, all right, because that's a cost of operating the property. That's income to the property, not a cost of transferring the property itself. Any kind of lender fees, points, prepayment penalties, that's a cost of buying money, not a cost of transferring the property. Here's one that's common: paying the buyer's closing costs. All right, so for example, part of the negotiation, the seller says, okay, I'll pay for the buyer's closing costs. That's something that could be subject to tax. How the accountant deals with that on the back end, that's up to the accountant. We don't get involved in that. When there's lender title policies, that's a cost of, for the lender, not a cost of transferring the property. Here's one that's important: impounds, such as property taxes and insurance. You see, I'm seeing it more often on transactions where even if you're putting 30–40% down, lenders are still requiring impounds of property taxes and insurance. That's money that you need to be bringing in because buying insurance and paying property taxes is a cost of operating the property. So be prepared when you're looking at a closing as to having some reserves on the side, sort of like what Rachel was talking about earlier. And I'm glad she kind of brought that point up about, she had reserves that she was using to fix up the property because she did not use exchange proceeds for that. So you cannot use exchange proceeds to make repairs or fix up a property that you're buying in a typical forward exchange. That's a whole nother discussion for another day if you wanted to do something known as an improvement exchange. But when you're doing a 1031, it's important to make sure that you're keeping some reserves on the side so you can close this transaction. All right, so those are some examples of closing costs, that are a part of an exchange that qualify and don't qualify. All right, so now let's get into the nitty-gritty of it. So you decide that you're going to sell your investment property. My recommendation is that you talk with your tax advisor to determine that based on your circumstances that doing a 1031 will benefit you, that you're getting you need to do this for tax deferral. When you get in contract with a buyer, that's when my role as the qualified intermediary is going to officially begin. There's nothing really for me to do until you actually have a buyer and you have a contract. You see, because the qualified intermediary has to be assigned into a contract. We technically now are going to become the seller of the property. All of this has to happen before your escrow closes. You cannot close on your sale and then later set up the exchange. If you do that, you have a full taxable event. So be advised that when you get in contract and open up escrow, you need to start engaging the qualified intermediary, because they're documents that we have to prepare. So I like to say you're going to see the real estate agent's documents, you're going to see the closing attorney or escrow company's documents, and you're about to see a whole nother set of documents for the 1031. Our documents are not the same as the realtor or the escrow or closing agent. So we prepare our documents by getting a copy of the purchase agreement and the title report. We send out our documents for signature. You sign them and return them. I know that sounded silly for me to say, but there's times where people get the documents and go, okay, I've got my documents. Unless you sign them, we're not involved yet. All right, so you have to sign them to put us as the qualified intermediary officially. So the buyer brings in their funds to close. The deed to the property is going to go directly to the buyer at the closing. The money is going to come to the qualified intermediary, because a part of the exchange is you cannot touch your funds. Any funds that you touch will be taxable. The date of the closing is going to start the time frame for the exchange. So this is when the 45 calendar days and the 180 calendar days both begin. Note, I'm emphasizing the word calendar. They're not business days, it's calendar days. So weekends and holidays count during this period. Now, we're going to go through the cycle, and then I'm going to come back to the identification in a minute. Once you get under contract with the replacement property, then we have to get assigned into that contract. So then we're going to be preparing documents on the purchase side, because technically we're now going to become the buyer of that property. You sign it when you're ready to close. We're going to wire the funds that we're holding into the closing, and then the deed at the conclusion of the transaction is going to go into the taxpayer's name. That's the cycle of the exchange. So keep in mind, you must set up the exchange and sign the exchange documents prior to the closing of the sale. You have to sign the exchange documents for the purchase prior to the closing of the purchase. We wire the funds. We're holding all the funds throughout this process. All right, so now let's talk about the identification rules, because that's one of the most difficult parts to the 1031. Now, there are 3 rules according to the tax code that you can utilize. You can only utilize one of the 3. The most commonly used rule would be the 3 property rule. Under the 3 property rule, you're physically limited to 3 addresses. You're not limited to dollar amount. So when Rachel sold hers, she identified a property of $550,000. And I don't know what I can't recall whether she identified other properties or not, but maybe she identified 2 others at $550,000. And if I recollect, her sale was somewhere around $380,000. So she needed to use the 3 property rule if she was identifying 3 properties of that size. Okay, no limitation to the dollar amount. But if she wanted to identify 4 or more properties, the prices for those properties that she's identifying are now going to come into play. If you wish to identify 4 or more properties, you can do that, but the aggregate value of all of those properties added up cannot exceed 2 times your sale price. So, for example, and I'm just going to say this example because the math is easier. If she sold for $400,000 and she wanted to identify 4 or more properties, the 4 or more properties, when you add them up, could not be more than $800,000. That's the 200% rule. If the values of those 4 or more properties exceeded 2 times the sale price, now she would have been out of the 200% rule into the 95% rule, which means basically unlimited properties, unlimited dollar amount, but she would have to have closed on every property she has identified. It says acquire 95% of the total value, but likely it have to be all of the properties. So when you're doing the identification, you have to be very careful which rule you're going to use, because these rules are serious. Because when we talked about the guidelines, okay, the 4th guideline was identifying. All right, so when you identify, This is very critical to the 1031. It has to be in writing. It must be unambiguously described. Okay. Must be hand delivered, telecopied. I don't know if anybody telecopies anymore. I'm assuming they mean faxing. Okay. Or otherwise sent by midnight of the 45th day. All right. So if the 45th day falls on a Saturday or a Sunday, that identification still must come in. Here's an example of what an identification form looks like. This is what our company, all right, it may vary from company to company. So you're going to fill out this form. You're going to fill out the address, the city, and the state. If you're identifying more than 3 properties, you're going to fill out the address, the city, the state, and the value of the properties. You want to make sure when you add it up, you're adding it up and it doesn't exceed the 200% rule, unless you're willing to go into the 95% rule, which is extremely, extremely risky for a 1031. You have to sign it, date it, and send it in. My recommendation is that people, when they're doing their identification form and they're ready to send it in, is that they send it in during business hours, because that way, if there's any issue that we can address, we can help you fix it. I had a client that was doing an exchange and the team said, send it in, send it. She's, well, I have until midnight tonight, right? Technically, yes. And she sent it in at 11:30 p.m. Well, nobody's going to be looking at the ID. And lo and behold, the next day, she forgot to put the city of the property she was buying. These are very critical. It's very technical. So just make sure that when you're doing an exchange, you're keeping abreast of the time of when you have to get this in. And then you make sure that you're getting it in sufficient time, that we can take a look at it. And if there's an issue, then you can revoke and replace the list and correct it. All right. Now, we're not going to know if you have the addresses correct. All right. So you want to make sure you're double checking everything that you're putting down. All right, now let's talk a little bit about multiple property exchanges. It's not uncommon for people that want to consolidate to sell multiple properties, to go off and to buy one property in the exchange. All right, the challenge when you're doing a multiple property exchange on the sales side is the timing for the exchange is going to begin at the closing of the first sale. So if you find yourself where you might be considering something of this nature, make sure that you're having a good conversation with with somebody like me, because I'm going to take you through the pros and cons of this kind of a transaction. Now, what we see a lot of right now is this, where somebody is selling one property and they're buying multiple properties. Just keep in mind that when you're doing a 1031, you must complete it. That's all the way to your last purchase by the 180th calendar day. All right. Again, if that calendar day, the 180th day falls on a Saturday or Sunday, you better be closing the Friday before, not the Monday after. If you're dealing with new construction, be very, very careful. We've had exchanges that have not been successful because the developer couldn't get the property delivered within the 180 calendar days. So again, like I said in the beginning, this isn't going to cover every aspect of an exchange. It's just giving you a broad overview. Now, let me go into a few things just to kind of wrap this up on my end. So here are some tips that I think is really important that when you want to try to complete a successful 1031. The first thing, and I think is the most critical part to doing a 1031, is that you need to consult your tax advisor or your CPA, because that's the party that's going to tell you whether you need to do a 1031 or should do a 1031. We as a qualified intermediary, Rachel as an investment advisor is not going to know your tax consequences, right? So you want to get that answer from whoever's doing your taxes. Do I need to do a 1031? Is it in my benefit to do one? It's also critical to keep your tax advisor involved in your transaction to review those closing and settlement statements, because we can't give tax advice as a qualified intermediary. We can highlight things that we're going to see on a closing statement that are going to be a problem, or we're going to say, talk to your tax advisor. We don't know how they're going to look at this particular expense. So you want to have your tax advisor review those closing statements, the closing statement from your sale, along with the closing statement for your purchase. When they're involved and engaged with you in this transaction, it helps to minimize any kind of surprises or any faux pas that could happen in the transaction. Consult your tax advisor, make sure that they're with you throughout this entire transaction. The next thing is to discuss the 1031 with the qualified intermediary or the accommodator. We're going to take you through the rules and the guidelines. I'm going to say this is the time frame. So kind of go what I just went over on this webinar on a phone, right? So I'm going to take you through everything. I'm going to answer your questions that you may have specific to your transaction. I'm going to give you the steps of what to expect. Like here, you're going to see a set of documents. When you get in contract with the purchase, let us know immediately. All right, so we can be prepared on our end. How to deal with any kind of earnest money deposits. So we're going to take you through all of that. I'm going to explain all of that to you. So you want to stay engaged. So you want to discuss the process with the qualified intermediary. So the first two are very critical to the success of the exchange. Now, the third one is for you now to start becoming more familiar with this process. For a lot of people doing exchanges, this may be your first time, you know, or maybe it's your second time and you haven't done one in 5 or 6 years. So again, familiarize yourself, understand what you need to spend for full tax deferral, understand how to properly identify the property. So we're giving you the information. The challenge is we don't always know what you're retaining. So it's important for you to stay engaged. If you're not sure about what you think you should be doing, ask questions, you know, stay engaged. Understand the full tax deferral. When we talk about this, that also brings back to the CPA. They can look at the closing statement. They can look at what you're putting down. It's important to look at those closing statements because if you're not familiar with the full tax deferral, maybe you're getting too much of a loan, like in my example. So become familiar with the requirements. I'm not saying you have to be an expert like, you know, me sitting in the field, but in order for you to be successful, it's important for you to grasp, you know, at least the basics of the 1031 so you can stay in charge of your transaction. All right, the next one would be confirm tax ownership investing prior to selling. Boy, this is a hot button item for sure. There are a lot of times when you're getting ready to sell a property, as an investor, you may not have looked at your title in years. Some people may have bought the property before they were married and they never bothered to change anything. Now you're engaged in a sale contract and subsequently going to be doing an exchange. Does the tax ownership reflect what's showing on title? So you want to make sure that there's accuracy there. So there's times where you might have somebody that's on title that, you know, say a spouse owned the property before, been married for 10 years, never bothered to put the other spouse on title to the property. Now they're selling it. So well, how do you fix that issue? In some cases, the investor might have bought a property as, say, for example, as a husband and wife. Through the course of the ownership, they decided to create a partnership, all right, because they had better tax benefits, but they never changed title. So now the title on that their closing agent's going to see and the tax reporting is not in sync. It needs to be in sync for a 1031. So if you're considering selling your investment property, find out, go look to see what your vesting looks like on your title, all right, and then make sure that it's matching your tax ownership. Again, brings back the CPA, because if it doesn't match, the CPA or the tax advisor will guide you how to fix that problem. And then to me, the biggest one is communicating. It's so important to be proactive in your 1031. You're the ones electing to do the transaction. So it's your transaction. You're relying heavily on the experts, which you should, but you still have to be engaged. So if you're in doubt or not sure, just make sure that you're asking questions. Don't assume anything. Talk to the people that you're working with in the transaction, so therefore they can tell you what the guidelines are. I know sometimes people will go and get their advice from their friends, their relatives, you know, whoever, and say, well, my friend did an exchange 2 years ago and they did it this way. It doesn't mean they did it right. So talk to the people, that the professionals that you're working with. Stay engaged. Know your timelines. Know when that 45 days is up. Know when that 180 days is up. All right. If you miss those dates, those are critical dates for a 1031. There's some things that sometimes that can get fixed in a 1031, and there's some things that cannot. So it is a tax code. So you just want to be aware that what you're doing is following the guidelines in order to try to for you to help have a very successful 1031. So that's kind of my major tips for the 1031. And at this point, I will bring it back, bring Rachel back in, and she can finish off with what she's got to say at the end.
Awesome. Thank you so much, Dino. That was super helpful, and I really appreciate all that insight. I know you made the process absolutely seamless, especially with your team support too. It's been really cool to see this side of the equation after you've helped so many of my clients.
I think that's always helpful, isn't it, when you're doing your own transaction?
Definitely, definitely, absolutely. So for anyone on the call that hasn't downloaded our property rating ebook, this is a great start for researching what you'd like for your up-leg property markets. You can kind of look at the different strategies and find the best fit for you. And this is a quick read from our CEO. Definitely highly recommend it. You can find it using the link below. And yes, on our Learn page of our website, you can also find our library of countless educational information. This is all free educational resources. A lot of other real estate investment companies out there really like to sell guru programs and charge their clients for that. We are staunchly opposed to that. We want our clients to spend their money on real estate and wealth building, not on any gimmicky things. And we have some amazing resources from top market experts like Dino that you can find at the click of a button anytime that works for your schedule on our website. And real quick, as far as a consultation, if any of you are not already working with an advisor, I would absolutely love to have a quick chat with you, get to know what you guys are looking for. Here's my information, and we can certainly discuss the 1031 exchange option with all of our different markets. I help our clients across the country. So as you can see, my exchange was between 2 of our different states, and a lot of our clients are doing the same. In fact, most of our clients, I would say, are exchanging over multiple states. So this is a common thing we do every day with our clients, and would love the opportunity to meet with you guys. So feel free to reach out, and I'll definitely get you connected with Dino as well. As far as the questions that came in, we will respond to those again later this week. But thank you guys so much for coming out tonight. I know this was super informative, and Dino, thank you so much for your time, and I hope everyone has a wonderful evening.
Thanks, Rachel.
Thanks. Bye, guys.